Welcome to The Explainer. Today, we're going to talk about something a little different in the crypto world. It's not about trying to guess the next moonshot. Nope. We're diving into a strategy for generating yield without having to ride those crazy price waves. It's called arbitrage trading. Okay, so what is arbitrage? At its heart, the idea is incredibly simple. You buy something cheap in one place, and at the exact same time, you sell it for more somewhere else. That difference, that's your profit. The key here is you're not betting on where the price is going. You're just profiting from a price difference that exists right now.
So here's our game plan. We're going to break down two of the most popular arbitrage strategies you'll see out there. First, the spot futures spread. Then we'll get into funding rate arbitrage. And finally, we'll get to the most important part, the reality check on the risks and rewards.
All right, strategy number one. This is all about capturing a price difference between what an asset costs right now, that's the spot price, and what people are willing to pay for it on a set date in the future.
Okay, so let's imagine this. You look at the spot market and you see you can buy one Bitcoin for $100,000 right now. But then you look over at the futures market and you see a contract that lets you lock in a sale price of $101,000 for that same Bitcoin, say 6 months from now. See that? There's a $1,000 gap just sitting there.
So how do you grab that $1,000? It's a two-part move you have to do at the same time. You buy the Bitcoin on the spot market and you immediately sell a futures contract for it. What this does is it creates a delta neutral position. Basically, because you're both long and short the same amount, you don't really care if the price goes up or down between now and then. Your outcome is already baked in.
And this right here is the magic of it. It seriously doesn't matter if Bitcoin skyrockets to 200,000 or crashes to 50. You bought it for 100 and you have a legally binding contract to sell it for 101. That $1,000 difference is yours. You just have to let time pass until the contract expires. Now, you're probably wondering, what does this look like in terms of returns? Well, in a real-world example from our source material, a 6-month Bitcoin trade like this was offering a 3.73% return. Now, that's for the 6-month period. If you annualize it, you're looking at close to a 7% APY. For a lower-risk play, that's pretty darn solid.
Okay. Let's switch gears to our second strategy, funding rate arbitrage. This one is a whole different beast. It works on a much shorter time frame. We're talking hours, not months. And it's all about a special kind of crypto derivative.
The engine that makes this entire strategy work is a crypto-native invention called perpetual futures, or as everyone calls them, perps. So what exactly are they?
Well, unlike the contracts we just talked about, perps never expire. They could, in theory, just keep going forever. Now that creates a puzzle. How do you keep the price of this contract connected to the actual real-world price of the asset? The answer is a really clever trick called the funding rate.
And here's where we find our opportunity. When the market is super bullish and way more people are buying perps, going long, than selling them, the perp price can start to drift above the real spot price. To pull it back down, the exchange basically makes the buyers pay a small fee to the sellers, the shorts. That fee is the funding rate, and our goal is to be the short collecting that fee.
The setup here is going to look pretty familiar. You buy the asset on the spot market, and you short the exact same amount with a perpetual contract. Again, delta neutral. But here's the twist. Instead of waiting for one big payday at the end, you're positioned to collect that funding fee over and over again, usually every few hours, for as long as it stays positive.
And this is where the yields can get really juicy. On some assets like Solana or Ethereum, you can actually stack your yields. You get the funding rate from your short position, plus you get staking rewards just for holding the asset in your spot wallet. In this example with Solana, the potential combined APY was hovering around a whopping 17%.
So where's that 17% actually coming from? Well, for this particular Solana trade, you can see that the staking APY provides the lion's share of the yield.
It's the stable base. The funding rate then comes in as a smaller, more variable cherry on top. That's really key. The funding can bounce around, but the staking gives you a solid foundation.
Okay, 17% APY. That sounds amazing, right? But before anyone gets too excited, we have to do a reality check. I cannot stress this enough. This is not easy money. Both of these strategies come with very real risks you have to be ready to manage.
For that first strategy, the spot futures trade, the biggest danger is leverage. If you use leverage on your short position and the price of Bitcoin suddenly has a massive violent spike upwards, you could get liquidated or stopped out. Your whole position gets wiped out. There's also just plain old opportunity cost. If Bitcoin happens to 2x while your money is locked up for a 7% return, well, that doesn't feel great.
Now, for funding rate arbitrage, the number one risk is right there in the name. That funding rate is not guaranteed. It can, and it absolutely does, turn negative, especially when the market gets bearish. And when that happens, your whole trade flips. Instead of collecting fees, your short position is now paying fees. Your money-making machine just went into reverse. You have to be watching it.
So it really just boils down to this trade-off. On one hand, you have the spot futures play, where you're aiming for a fixed, predictable profit that you get at the very end. On the other hand, you have the funding rate play, which is all about capturing a variable, ongoing income stream bit by bit.
At the end of the day, neither of these strategies is about getting rich quick. That's not the goal. You are making a very specific trade-off. You're giving up that lottery ticket potential for huge, explosive gains in exchange for a more predictable, steady cash flow from your assets. It's almost like turning a volatile crypto asset into something that earns interest. And that leads us to the final and maybe most important question. Now, platforms like OKX and Binance have tools that make these trades easier to execute, but they are not set-it-and-forget-it investments. They take capital, they take active monitoring, and they take a real understanding of the risks. So you have to ask yourself, is that potential for a stable, market-neutral yield worth the complexity and the active management that it demands? That's the real question.